So, what really separates the legendary investors from, well, everyone else? It's not some secret formula or a crystal ball. It's actually a set of timeless principles. And today, we're going to break down these 7 golden rules that can completely transform how you think about investing. Let's dive in.
All right, let's just get this out of the way right up front because it's a question a lot of people have. Is the stock market just a big casino? Are we all just taking a high-stakes trip to Vegas where the house is destined to win? It's a really common fear, this idea that you're just gambling your hard-earned money. But what if I told you there's a completely different way to look at it?
See, the difference? It all boils down to your mindset. A gambler, they're playing a game of luck. They're making these short-term bets, trying to perfectly time the market. But an investor? Oh, that's a whole different ballgame. An investor focuses on the real value of a business, thinks in terms of years or even decades, and they understand that it's the time you spend in the market that builds real, lasting wealth.
To help us get there, we've organized these 7 rules into 4 core ideas. We're going to start with a different way to think about things, then we'll get into buying the right way, followed by how to master your own mind, which is huge, and finally, how to build for the future. So let's kick it off with our first section, a different way to think. Because look, before you make a single trade, the absolute most important investment you can make is in your own perspective. It's all about building the right mindset, not just reacting to every little up and down moment in the market.
And that brings us straight to golden rule number 1. Think long term. This right here is where you can get a massive advantage, even over the pros on Wall Street. It's something called time horizon arbitrage. See, the big funds, they're often forced to think about next quarter or maybe even tomorrow. You're not. Your ability to just look past all that daily noise and focus on the next 5, 10, even 20 years, that's a genuine superpower.
Let me tell you a quick story that just nails this point. Back in 1964, American Express was a fantastic company, but its stock got absolutely crushed by this bizarre scandal involving barrels of vegetable oil that turned out to be mostly water. The market freaked out, focusing only on the immediate losses. But Warren Buffett, he looked right past that temporary chaos, saw the incredible long-term strength of the brand, and invested a ton of money. The lesson is so powerful. Long-term thinking lets you find value where short-term panic just creates an opportunity. And Buffett basically distilled this entire philosophy into one powerful gut check. Before you buy anything, ask yourself this: would I be happy owning this company if the entire stock market just shut down for the next 10 years? It is the ultimate test of your conviction, and it separates real business ownership from just speculating.
All right, so let's move on to our second rule, which builds perfectly on this idea. Good companies make good investments. This is a huge shift in thinking. You're not just buying a ticker symbol that blips up and down on a screen. You are buying a small piece of a real, living, breathing business. So the quality of your portfolio is really just the average quality of the businesses you own. Simple as that.
So, what do we even mean by a good company? Well, first, it's a business with a unique advantage, something that others can't just come in and copy. Investors have a cool name for this. They call it a moat. It's also a company that makes really high returns on the money it reinvests. And, this is crucial, it doesn't need to borrow a ton of money because its own operations generate enough cash to pay for its growth. This is one of the most famous investing quotes ever, and for good reason. It's a critical warning against the siren song of a bargain bin stock. It is so easy to get seduced by a super cheap price. But trust me, a mediocre business will almost always let you down in the long run, no matter how little you paid for it. Quality always has to come first. Okay, so we've got the mindset covered. Now for our second section, buying the right way. This is where we turn that mindset into disciplined real-world action. It's all about the art of the smart purchase. Which leads us directly to rule number 3, buy with a margin of safety. Now, this is a cornerstone idea from Benjamin Graham, the guy Warren Buffett called his teacher, and it is, without a doubt, the single most powerful risk management tool that you have as an individual investor. So, what on earth is a margin of safety? The easiest way to think about it is like a protective cushion. It's the gap between what you conservatively figure a business is really worth and the price the market is offering it to you for today. You only buy when that gap, that discount, is significant. That gap is your built-in protection against being wrong. And I love this quote because it just makes the whole concept so simple. Heads I win, tails I don't lose much. That's what a margin of safety does. It stacks the odds in your favor. It creates a situation where the potential upside is just way bigger than the potential downside, protecting you even if your math isn't absolutely perfect.
Of course, none of that is even possible without rule number 4, do your own homework. I mean, let's be real. Buying a stock because you saw some talking head on TV mention it, or because your buddy gave you a hot tip, is a guaranteed way to lose money. There are absolutely no shortcuts here.
As the legendary investor Peter Lynch said, you absolutely have to know what you own and why you own it. And that research, it's not just some boring school assignment. It is the source of your conviction. It's the very thing that'll give you the guts to hold on during a market crash, or maybe even buy more when everyone else is running for the exits.
And that is the perfect transition to our third and maybe the most difficult section of all, mastering your own mind. Because so often, the biggest enemy we face in investing isn't the market, it's that person staring back at us in the mirror. And this is captured perfectly in rule number 5, don't follow the herd. As human beings, we are literally hardwired to seek safety in numbers. It's instinct. So we buy when everyone else is buying, which fuels a bubble. And we sell when everyone else is selling, which locks in our losses during a panic. It feels like the right thing to do in the moment, but in investing, it is a consistent recipe for disaster.
And here is the ultimate antidote, another piece of timeless wisdom from Warren Buffett. This is way more than a quote. It's a psychological operating system. Your job as an investor is to be the rational one buying things when fear has driven prices into the ground, and to be the skeptical, cautious one when greed has pushed prices to insane heights. It's all about consciously doing the opposite of what the crowd is doing.
All right, let's move to our final section and see how all of this comes together in building for the future. This is about the long-term strategy, how you actually construct and grow your portfolio over time.
And that strategy begins with rule number 6, smart diversification. Now look, we've all heard don't put all your eggs in one basket. And it's true, you will make mistakes. And diversification protects your entire portfolio from any single bad decision. But there's a flip side. Don't have so many baskets that you can't even keep track of all your eggs.
And this chart shows you exactly why. The research is pretty clear that a portfolio of around 20 well-researched stocks can give you about 90% of the benefits of diversification. Once you go way past that, you just start to dilute your best ideas, and you can't possibly know enough about each company, which you'll remember breaks rule number 4. And that brings us to our final, and you know what, maybe the most important rule of all. Never stop learning. You can't apply any of the other 6 rules without this one. Markets change, industries get disrupted, and you are going to make mistakes. As the brilliant Charlie Munger said, the game of life is the game of everlasting learning. At least it is if you want to win. The best investors stay humble, they stay curious, and they are always, always learning.
So there you have it, the 7 golden rules. It's about thinking long-term, buying quality businesses with a cushion of safety, doing your own work, mastering your own emotions, and diversifying smartly. But remember, this isn't a destination. It's a journey of continuous learning. And so we'll end this not with an answer, but with a question for you. What will you learn about next?